Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to give you an update on the portfolio here. But we're also going to talk about the three types of investors when it comes to just investing in paper assets. And so we will get right into it. We'll go through the portfolio and then we'll talk about that, and then we'll kind of go from there. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so portfolio today, closing the balance out at $3,755.66. Today we are down $4.99, down 0.13%. For the 1 week, we are down $75.27, down 1.96%. For the 1 month, we are up $231.60, up 6.57%. For the 3 months, we are up $344.48, up 10.10%. And for the 1 year, we are up $586.66, up 18.48%. And all will be the same. Always happens every time. There was an error, just retry. Come on, there we go. Same thing, up $585.66, up 18.48%. First position we own is Bell Canada, ticker symbol BCE, closing out at $57.59, down 13 cents on the day, down 0.23%. We own 8 shares of this. Total position value of $460.72. Our average price of getting in is $56.41, and it holds about 12.77% of the portfolio. Today's return was down $1.04, and our total return since owning the position is $9.46, up 2.1%. Next position we own is Bank of Montreal, ticker symbol BMO, closing out at $109.65, down $1.11, down 1% on the day. We own 5 shares of this. Total position value of $548.25. Our average price of getting in is $81.32, and it holds about 15.2% of the portfolio. Today's return was down $5.55, and our total return since owning the position is $141.65, up 34.84%. Next position we own is Bank of Nova Scotia, ticker symbol BNS, closing out at $78.05, down 51 cents on the day, down 0.65%. We own 7 shares of this. Total position value of $546.35. Our average price of getting in is $54.58, and it holds about 15.14% of the portfolio. Today's return is down $3.57, and our total return since owning the position is $164.30, up 43%. And next one is Loblaws, ticker symbol L, closing out at $69.29, up $2.34, up 3.5% on the day. We own 6 shares of this. Total position value of $415.74. Our average price of getting in is $63.27. And it holds about 11.52% of the portfolio. Today's return is up $14.04. And our total return since owning the position is $36.11, up 9.51%. And that is Loblaws. Next position we own is Manulife Financial Corporation, closing out at $26.56. We are down 39 cents on the day, down 1.45%. We own 17 shares of this. Total position value of $451.52. Our average price of getting in is $19.26, and it holds about 12.51% of the portfolio. Today's return was down $6.63, but our total return is up $124.08, up 37.89%, and that is Manulife Financial Corporation again, ticker symbol MFC. Next position we own is Royal Bank of Canada, closing out the day at $115.84, down 14 cents on the day, down 0.12%. We own 4 shares of this. Total position value of $463.36. Our average price of getting in is $106.74, and it holds about 12.84% of the portfolio. We are down 56 cents on the day today. And our total return is, since owning the position, is $36.39, up 8.52%. And that is Royal Bank of Canada, ticker symbol RY. Next position we own is TELUS Corporation, ticker symbol T, closing the day out at $26.35. No movement today, zero loss, 0% gained. We own 15 shares of this. Total position value of $395.25. Our average price of getting in is $26.25, and it holds about 10.95% of the portfolio. And again, no return today. But our total return since owning the position is $1.51, up 0.38%, and that is TELUS Corporation, ticker symbol T. Next position we own is Toronto Dominion Bank, ticker symbol TD, closing out at $81.72. We are down 42 cents on the day, down 0.51%. We own 4 shares of this, total position value of $326.88. Our average price of getting in is $74.51, and holds about 9.06% of the portfolio, down $1.68 today, down 0.51%. And our total return since owning the position is $28.83. And that is up 9.67%. And that is TD. And that is the position we'll be updating this Friday. We have $147.59 in the cash portion. So that has increased since last video because I figured out that I can make deposits on Sunday and it will show up in the account right away. So that we don't have those weird numbers that we had in the past few videos. So I'll show the proof right here. And then we'll accept these referrals, which is super awesome. We have 2 referrals that came in from Eva and Taylor. So thank you so much. So we'll claim those and we'll put those in TFSA right now. Boom. And then we'll claim this one, claim that one, and boom. Because what was happening, and so total now we have $220 earned from referrals. So if you guys are, starting out and trying it on Wealthsimple, there is a referral code down at the bottom where you'll get $10, as you can see on the screen. I'll get 25 and you'll get 10 for at least when they deposit and trade at least $100. So if you want to use that, go ahead. If you don't, doesn't bother me. So it doesn't affect the screen right now, but oh, it did. No, it didn't. But if we refresh it, does it? Retry. Hold on. Nope, it's broken now. It's broken. Anyways, but yeah, so thank you to those guys. I really appreciate it. It's not that you have to, but any amount really does help. And so thank you so much for that. But today we're going to talk about the 3 types of investors that are in the marketplace, and one of them might fit you. And there is no best type of investor. It's just where you're at in the journey. There is no answer to that question, but it is the right question uniquely to that person. And so the first investor that we're going to talk about is the pre-investor. Unless you were born with a massive trust fund, you are probably in the same boat that I was in before I got started investing. And that is somebody who has never thought of investing or never does investing, and typically pre-investors don't have any sort of investment other than maybe a RSP or a 401k at their work that has been set up by another party of the company. And that is their only type of investment that they have. They typically don't look at developing any investing knowledge of the sort, or really even consider. These are typically, and it's not a bad thing. We all start here. We all start as a pre-investor, and when you're a pre-investor, you're usually living paycheck to paycheck. It's not a concern, and typically a pre-investor's main priority is consumption. And using all their capital maybe to live, and it's different for everyone. Everyone's situation is different. They typically will, with a raise, have a bigger lifestyle. Their lifestyle is more important as the current now than their financial security in the future. However, as we grow into maturity, that's kind of typically where we go into the next type of investor. But for pre-investors, it's not a bad thing. We were all there. I mean, for me, I was even there where, investing wasn't something I wanted to, never even thought of, because they don't teach it in school. They're not saying, when you're 5, you should start investing or anything like that. It's typically just, just living the now and getting your first, job, or career, and spending that money to, have that lifestyle, and consumption is the number one thing. Is we buy this, we buy that, and not think, how much is this going to cost me in the future? So those sort of things. But then once we get older, or some of us mature faster than others, and we take on responsibilities quicker, and some not, this is where we get into the next step. So the first one was a pre-investor, someone who maybe has no idea about investing, and the closest thing to investing is their 401k at work or their RSP contributions with their company. It does typically a matching program, and they're not concerned about it. And so it's not a bad thing. They typically check to check, and they're typically just saving the money and then consuming it with goods. So not a bad thing, but we've all started there. Unless you walked into a giant trust account and you just don't want to invest. And so it's okay. There's nothing against that. I'm not judging that, but it's just where we start. And so the next one is your passive investor. Passive investors are typically people that are just starting out. These are there's no scientific study on this or any kind of survey, but I'd imagine that 90% of investors probably fall into this category as a passive investor. And the key points for passive investors are people that are just starting out and go to, let's say, someone else to manage, their investments. And that's like the banks, investment advisor, somebody in the professional field of investing. And you'll typically go into mutual funds, GICs, stocks, indexes, just anything of the sort, but you don't manage it actively. And somebody else manages it for you. Or another key characteristic of a passive investor is somebody who likes to ride out every single thing, like roller coasters in the marketplace. So up, downs, they typically dollar cost average down. They hold it forever, and they don't actively seek out information. This is where 90% of us probably, and again, there's no scientific fact about this, but I'm just assuming that 90% of investors fall in this category. We might think that, we are active or on the next level, and I'll get into that. I might have ruined that one, but passive investors will typically buy something, hold it, average down, and just hold it forever for retirement. These are people that will typically take 10%, save it, just like the simple rule is, take 10% of your income, put it somewhere, invest it, and max out every single registered product, so an RSP, tax-free savings account, as much as you possibly can. These are the people that will typically buy a house on the market at retail price, and they don't look at, building wealth. These are people that will work very hard for their money, as we all do, but don't work as hard in their investments as they do as earning and saving their money, if that makes sense. So again, they work hard for their money, like grinding to the bone to save it, and they invest some of it, but they don't work as hard in investing as they do working for that money. And so this is where it takes us to the next step. This is where, people don't, for the majority, people don't like to take that risk. Nobody does. They are willing to take less risk, but have less gains as well when it comes to their investments. They like to when they minimize that. So it's like, let's say this is the risk of something coming down, and this is the reward of something going up. You're typically in the medium where you reduce the amount of risk, so that in turn it will reduce the amount of reward when it comes to investment. And that is typically your passive investor. And some of us subconsciously, we don't know that we're a passive investor. We may think that we are these big shot investors. I know I did when I was younger. When I started investing, I was like, yeah, I own securities, I own stock, big shot, right? And now I've learned that, for the most part, we're not better than anyone else. We're just a passive investor. We put our money, we don't want to look at it. It'll grow on its own. For the most part, someone else will take care of it. And hopefully they take care of it enough that when it comes to retirement, we are good. And so that is your passive investor. Your next investor, which we grow into typically after some years of investing or experience in the markets. This is where we are called active investors, and you grow. It's typically a build up from being a passive investor. You're building upon on top of that, and this is where the difference is made. This is somebody who actively increases their knowledge around investments, around finances, around stocks, around companies, and they look for certain things in the marketplace and they invest in certain things. And so I'll give you examples of this because they're the passive investor and the active investor are very similar in a lot of ways. There are just certain things that are different in an active investor than a passive investor when it comes to mindset. And I'll give you an example and hopefully I can make sense of it. So again, the active investor is the third type of investor. This is a person that has done the passive income, but now, or at the same time, typically will jump to that active side and just skip passive and just go right into it. And I don't recommend that. But the active investor will typically do their research. It's like a business owner. For example, in business, every company has a competitive advantage. And an example of that is Apple. Apple has a competitive advantage when it comes to their products. Their products are like my phone here, and my Mac, my AirPods and things like that. They are all integrated into an ecosystem. And from other companies, Apple seems to be the only one that has that competitive advantage in the business world, where everything is an ecosystem, and that that pays homage to their success and their continued success, because they have this this idea where it's an ecosystem, everything is locked in together, and they continue to do it that way, and they go through cycles with their phones, with almost everything, their MacBooks, their iPads, their just everything. And so that is a competitive advantage in the business world. How do we relate that to your active investor? We call it an edge, a financial edge or investment edge. And what it's like is like somebody doing their research, looking for inefficiencies in the marketplace. And when I say inefficiencies, I mean a company that is very undervalued by the stock market or by analysts or anything like that. And active investors will always, they work just as hard in their investments as they do at their job to earn that money and put away money. They work the exact same amount in their investments. They'll look up information that they need, and they'll analyze things, and they'll really come to their own evaluation of a company if they believe in that company. And some of us might think that we believe in a company, we think it's worth that much, but based off of what? Compared to what? Where are you getting that information, and how credible is that information? Like, we can't say that, a company is worth $10 trillion if it's not worth anything, if it doesn't even have a product. How can we say that, right? And so this is where people start actively learning about finances, actively figuring out what is the company worth to them, and what it's going to bring in the future. And so active investors are like real estate, are people who are in real estate. I'm not into real estate. I hope to be in the future, but somebody who is in real estate and buys real estate property can go up to a property and see that it's a bit run down, and look at the price and be like, that's a steal of a deal. Do some renovations and flip that house for even more profit. And they found an inefficiency in that house to make it worth something. And a perfect example of this in the marketplace is Warren Buffett. Warren Buffett is the Oracle of Omaha. Here's a man that speaks very heavily in value investing, and his edge is being able to analyze certain companies and see the value in that company, even though that the market might say it's not worth that much. And he's done that time over time with the companies he holds in his portfolio. And so it comes down to his value and what he sees in the company. And he has made a vast fortune over it. him and Charlie have done a fantastic job in seeing, the inefficiencies in the marketplace, and they capitalized on it. They made a ton of money on it. And so, that's your active investor, is somebody who does the research, looks into the company, finds value in the company, and knows that what the price is at today is maybe undervalued, even if it is at a high price, like let's say an all-time high in some position. But even that could be an undervalued company based on the market. And so your active investor will do the research, will look into it and figure things out. And so that is pretty much your active investor. That is the main difference when it comes from a passive investor to a active investor. And that is putting just as much work in your investments as you do your work and your earned income, your active income. And so hopefully that makes sense. And so I don't know if that all made sense, but I can't go too much into it because this video is going to be a long video. But subcategories that come into passive investor and active investors, these are like your day traders, your swing traders, options traders. There's so many traders or so many types of investing within those two categories. They're typically subcategories, and everyone has their different style. Now, I don't want people to think that, you are one of these and one is better than the other. No, I'm not saying that. I am saying that there is no right investor, but there is one that you probably fall into, and it's okay. I would say I'm more in between the passive and the active. I'm not fully active, but I do enough to be in the middle somewhere. I like my passive investments, like my index funds, but then I like to look into companies that I believe in, and it's not in this portfolio, but I have companies that I own securities in that are not in this portfolio, that are growth stocks that I truly believe in, that I've done my research, and I don't go based off what I heard from somebody saying that I overheard at a coffee machine or whatever it is. I'm not going to go and just throw my money in there. I'm going to do my research. I'm going to get credible information. But yeah, I hope to be on the way to being an active investor where, I'm doing my research. I develop a skill set to develop my edge for the market and see inefficiencies and exploit it. Because that is probably the way that, it is the way that Warren Buffett and Charlie did it. They exploited inefficiencies in the marketplace and they destroyed it. They literally made a boatload of money from, finding the inefficiencies and going all in on that. And so hopefully that did make sense, guys. Again, I'm not a financial advisor. I'm definitely not your financial advisor, but those are, it's just my opinion. Those are the three investor types in the marketplace. And then there's subcategories, like hundreds of subcategories in the two, passive and active, which could be like your hype investor, your FOMO investor. There's so many playoffs of that, but those are the three main types. First one, again, is your pre-investor, is somebody who maybe only has, we'll do a recap. So the pre-investor is the only person that has, like an RSP that matches with their company, and it was set up not by them. It was set up by the company, and most of their life is through consumption. That's their main priority, and going check to check, and maybe saving some here and there. And then it goes to your passive investor who looks at, they work hard, they put 10% away, but they don't work as hard in their investments as they do their job. And they're just looking for financial security. And they let someone else take care of it. And they typically will ride out the roller coaster, put the money in, ride out the roller coaster, let it do its thing. It'll grow over time, 100%. And then there's your active investor, which is a runoff of a passive investor, someone who's looking to build the wealth in their portfolio and works just as hard as equally as their job or whatever it is, their business, and in their investment portfolio. And they develop a skill to create, an edge in the marketplace for themselves to create that wealth. And so they have a pretty good understanding of wealth building instead of just money building. And so hopefully you guys did enjoy the video. And we'll definitely see you in the next one, and have a great week. Bye.